Hello and welcome back to the Global Business Channel. I'm your host Jonathan, and in today's video we're diving into an essential topic for financial institutions and compliance professionals, FATF Recommendation 11 on record keeping, which keeps us on track to complete the full analysis of the 40 total recommendations issued by the Financial Action Task Force. Here's what we'll cover in this video. Number one, what records are for financial institutions, understanding the types of documentation you need to maintain. Number two, what record keeping really means, why proper record management is a cornerstone of compliance. Number three, regulatory provisions regarding record keeping, the rules and expectations for financial institutions. Number four, why record keeping is important, from and AML and CFT compliance to regulatory audit. Number five, a deep dive into FATF Recommendation 11, what it requires and how it applies in practice. And finally, number six, no interpretative notes. Unlike some other FATF recommendations, this one stands on its own. By the end of this video, you'll have a clear understanding of record-keeping obligations, why they matter, and how to stay fully compliant with FATF standards. Let's dive right in. Let's start by understanding what records financial institutions are required to keep. Proper record keeping is the backbone of AML, CFT, and CFP compliance. Key points and types of records include: number one, customer identification records. Information collected during KYC and customer due diligence processes, includes personal details, identification documents, and beneficial ownership data. Number two, transaction records. Details of all financial transactions, whether domestic or international. It helps financial institutions track fund flows, detect suspicious activity, and comply with regulatory audits. Number three, business relationship records. Documents regarding the purpose, nature, and terms of the business relationship, which includes contracts, agreements, and correspondence with the customer. And number four, supporting documentation. Any additional information or evidence that supports due diligence, risk assessments, or decisions made during the business relationship. Key takeaways: these records allow financial institutions to prove compliance, support investigations, and maintain transparency. Without proper records, institutions expose themselves to regulatory and operational risks. It is important to note that records include both manual or wet ink, digital, and electronic versions. Now that we know what records financial institutions must keep, let's discuss what record keeping actually means in practice. The meaning of record keeping includes the following. Number one, maintaining accuracy and completeness. Records must be accurate, complete, and up to date, ensuring that all customer information, transactions, and business relationships are correctly documented. Number two, ensuring accessibility and organization. Records should be organized and easy to retrieve when needed. This is critical for regulatory inspections, internal or external audits, and any kind of reviews. Number three, supporting compliance and oversight, enabling financial institutions to demonstrate compliance with AML, CFT, and CFP requirements. It helps identify suspicious transactions and respond to regulatory inquiries effectively. And number four, preserving records for the required period. Financial institutions must maintain and retain records for the period prescribed by their local law or regulation, ensuring that historical data is available for investigations, reporting, or audits. Once again, the key takeaway: effective record keeping is not just a paperwork exercise. It is a critical compliance tool that protects institutions, its customers, and the broader financial system. Next, let's explore the regulatory framework for record keeping. Understanding the rules is key to staying compliant and avoiding penalties. Key points and what the regulations usually require include: number one, legal obligation to maintain records. Financial institutions are legally required to keep records of customer identification, transactions, and business relationships. Non-compliance can result in fines, sanctions, or license restrictions. Number two, retention periods. Records must be kept for a minimum period as defined by local law, which usually stands between 5 and 10 years, depending on the jurisdiction, ensuring that authorities can access information for audits, investigations, or regulatory reviews. Number three, format and accessibility. Records can be physical or electronic, but must remain complete, organized, and easily retrievable. This facilitates regulatory inspections and internal audits. Number four, cross-border compliance. For international transactions, financial institutions must comply with both local and foreign regulatory requirements regarding record retention and reporting. And number five, integration with AML and CFT obligations. Proper record keeping supports Know Your Customer or KYC, customer due diligence or CDD, suspicious transaction reporting, and risk management. As a key takeaway, adhering to record keeping regulations is not optional. It is a core part of compliance, protecting both the institution and the global financial system. Now, let's talk about why record keeping is such a critical part of compliance for financial institutions. The importance of record keeping functions to notably, number one, support AML, CFT, and CFP compliance. Records allow institutions to demonstrate adherence to FATF standards and local regulatory requirements. They are essential for investigating suspicious transactions and mitigating financial crime risks. Number two, enabling risk management. Historical records help assess customer risk profiles and detect unusual patterns, supports decision-making for ongoing monitoring and enhanced due diligence. Number three, facilitating regulatory audits and inspections. Well-maintained records ensure that regulators and auditors can easily verify compliance. This reduces the risk of penalties or sanctions due to missing or incomplete information. Number four, protecting financial institutions and their customers. Accurate records provide evidence of compliance in case of disputes or investigations. It also enhances trust and transparency in the financial system. Number five, supporting strategic business decisions. Historical transaction data and customer information can help identify growth opportunities and tailor products to clients. Once again, the key takeaway: record keeping is more than a regulatory requirement. It's a strategic tool for compliance, risk management, and building trust in the global financial system. Now, let's focus on the FATF Recommendation 11 and what it explicitly requires from financial institutions. The FATF requires that financial institutions maintain records for at least 5 years for all transactions, both domestic and international. Why? So that if authorities request information, the institution can swiftly provide the necessary details. These records must be detailed enough to reconstruct each transaction, including amounts, types of currency, and other key information. This is essential for investigation or even criminal prosecutions. But it's not just about transaction data. Institutions must also keep, for example, customer due diligence records like copies of ID documents, passports, identity cards, driver's license, etc., account files and business correspondence, analysis results such as inquiries into unusual or complex transactions. All of these records must be retained for at least 5 years after the business relationship ends or after the occasional transaction takes place. Finally, Recommendation 11 requires that these records be accessible to domestic competent authorities whenever they have the appropriate authority. In short, keep thorough, accurate, and accessible records because proper documentation is the backbone of compliance, risk management, and legal accountability. To wrap up, FATF Recommendation 11 highlights the critical role of record keeping in financial institutions. Properly maintaining customer transaction and business relationship records includes supporting AML, CFT, and CFP compliance, enabling effective risk management, facilitating regulatory inspections and audits, protecting both the institution and its customers, and strengthening transparency and trust in the global financial system. Remember, unlike other FATF recommendations, Recommendation 11 has no interpretative notes, so the requirements are straightforward and clear. Well, that's it, folks, for today's video. If you find this one helpful, don't forget to like, share, and subscribe to the Global Business channel. Turn on notifications so you never miss any updates on FATF standards, AML, CFT, and CFP guidance, as well as insights into the global business sector. If you got any questions, drop your comments below. I reply to everyone. Stay safe, stay strong. Catch you in the next one. Cheerios.